Hello and welcome to this Markets Today special. I have with me today Anand Shah, who heads PMS and AIF at Prudential ICICI or ICICI Prudential Asset Management Company. Anand, very good to see you today. But let me start by asking a very simple question. How difficult has it been for a fund manager like you to beat the market over the last 1 year? I mean, the benchmarks that you follow or adhere to.
It's a pleasure to be here. Thank you for inviting me. I think last 2 years, 3 years have been actually easier than what it was before. Prior to around January 2020, we had a very narrow rally in a very specific end of the market only. And a very broader market was underperforming the index. Having said that, last 2.5, 3 years have been actually where the profitability across broader market has been much better than the blue chips, and to that extent, stock picking is actually working wonderfully over last 2.5, 3 years. So last 2.5, 3 years have been pretty much easier, and also it's actually a stock pickers market. So a lot of alpha also is something we could generate in last 2.5, 3 years.
So what are the sectors and stocks that have resulted in the alpha that you've been able to generate? I mean, relative to the market, what are the bets which have worked out for you?
Yeah, so I think if I go back a little bit into the history, what was happening was you had, as I was saying, a very narrow segments of the market doing well. And partly that was also to do with that if you were a manufacturing something, if you're a manufacturer of something, you had a very stiff competition from China. China was practically the factory for the rest of the world, and they would produce from safety pin to boilers, from tire to tiles. Whatever you need, they would manufacture it for the rest of the world. So globally, ex-China manufacturing was struggling. But in the same time, if you're a consumer of those manufactured goods, would be a typical consumer or a consumer-facing businesses which were doing very well. What has changed in the last few years, and precisely more forcefully in the last 3 years, is China, which was an exporter of deflation, has become an exporter of inflation. And to that extent, a lot of manufacturing and manufacturing allied businesses, which includes corporate banks. So even within banks, if you see, a lot of corporate banks which were also at the receiving end of stress in manufacturing, stress in infra, leading to a very large NPAs and so much so provisionings for the same, have also seen reversal of fortunes. So I think our focus on manufacturing allied corporate banks, these are the areas where the earnings growth has been strong, valuations were very reasonable to start with, have helped us generate a lot of alpha.
But alpha is also generated by staying away from underperforming sectors. So which are the sectors which you have ducked over the last year or so, which has resulted in you beating the index?
Yeah, so through the last 2.5 years, we've been avoiding consumers. Last 1 year, we didn't have any IT in the portfolio. We didn't have any pharma in the portfolio. This was again, businesses were great, but they were priced for a far more growth than what actually was. So we sort of avoided businesses where the growth was mispriced. Our reading of the market told us that the growth that market was expecting was not possible. So those are the sectors we avoided, which also helped us generate a lot of alpha. Right.
No, but this is an interesting conundrum for you, because some of these franchises in consumers and even IT, I would say, though more consumers, they're actually very good companies. The valuations may have been wrong. So at what point do you say there has been enough time and price correction, at least time correction, and one might look to recalibrate the portfolio somewhat? Are we anywhere close to that, or do you see the underperformance lingering for many years?
So I think what we are looking at, today, the good news is that a large part of the economy will do well. This was unlike pre-2020, where a very small segment of the market was doing well. And to that extent, the challenge is now what are the sectors, what are the companies where the growth would be much better than expected, and what are the businesses where growth would be lower than what the market is expecting. In some of these businesses, especially in consumer-facing businesses, what was happening also in last decade or so, you had, massive margin expansion on the back of low inflation. So your input cost was not going up. You had enough pricing power on the consumer end. So you actually had between 600 to 1200 basis points of margin expansion. What is going to happen in years to come is China, which was an exporter of deflation, will export inflation. At the same time, your consumer is still stressed. It's not. It's been a K-shaped recovery. We have been talking about it for a while. So it's not that consumer is ready to pay you for that inflation. And to that extent, what we are expecting or what we are fearing is many of these businesses have still some way to go where their margins can shrink further. And to that extent, we are waiting. Again, not that these stocks after the underperformance have become, very, very cheap. The valuation still remains steep. People's expectations are very high from them, both in terms of growth as well as return on equities. And our take is both are, challenged at this point of time. Some of them will have incremental competition also. Like paints industry, you're seeing there's so many new players entering. Similarly, in many of brand businesses, there are D2C brands which are coming up. Also, there is a ownership of customer, whether it belongs to the consumer business or whether it belongs to the organized retailing. So those are the challenges which are there in those sectors. So we are evaluating them on a regular basis. We have a very large team of analysts which tracks all these sectors. But as we see today, the risk reward still remains favorable for the businesses that we've been owning for last 2 years, 3 years, which is manufacturing, manufacturing allied, and corporate banks.